Hi guys, welcome back to my channel. Today I'll be showing you of an Excel sheet that I've been using to track on different REITs of my interest. If you like my content, please like, subscribe and comment on anything else that you would like me to share on. When it comes to investing, it's very important that you do proper research and tracking of the specific stock or REITs, because investing in specific stock or REITs rather than on index or funds sometimes have a higher chance of giving a much better return. However, this means that more homework must be done as well. So today I'll be showing you guys and guide you through my Excel sheet, which I would time and time again update as time passes. However, do take note that a few conservative assumptions are being made so that better investment or more conservative investment can be done. So if you look at this very first page, it shows a table of distribution history of different REITs that have been given throughout the years. So for full year of 2022 and 2023 estimated, I've taken the assumption that based on what their current dividends are, they are able to maintain it. By considering this amount of dividend for this full year, to me, it can be considered a conservative, considering some REITs have managed to consistently increase their dividend, as you can see from the compounded annual growth rate, which is the CAGR. If you look at some REITs, they have higher CAGR than the rest. However, it's important to do your research and check on the reasons. How are they growing quickly and whether the current valuation is reasonable. One golden rule that I always give myself is that a REIT should always be able to give a reasonable yield that I would favor at the current share price. So like a yield that I would find it reasonable is at approximately 5.5% dividend yield. So one of the prime examples that happened of overpricing or overvaluating of REIT is during the August and October of 2020, where Keppel DC REIT, you can see now is at the price of $1.96, had rose all the way up to $3.04 during this period, and it actually gave a very low dividend of 2.9%. So the reason why it was such a low yield and such a high price was because there was a lot of euphoria during that period for data centers, and Keppel DC REIT was exponentially increasing their dividend yield distribution. However, you must always take note that this kind of huge incrementation is very hard to maintain, which is the similar concept to how growth stocks can fall in share price when their growth is no longer there. So let's take a look at the rest of the values on the table. So if you can see, there is a lot of different terms, financial terms, that you are required to understand when it comes to reading of REITs. As you can know from my previous video, I've always looked at a few different parameters as a quick look in order to determine whether the REITs is of good value or if I'm interested to read up more on it. So what is gearing ratio and interest coverage ratio? Gearing ratio are financial ratios that compare some form of owner's equity to debt or funds borrowed by the company. So which means that it is essentially debt compared to an asset. So as you can see from the example, if the Mapletree Industrial Trust gearing ratio is at 38.4%, which means that 38.4% of the asset is comparable to the debt. Interest coverage ratio is another parameter that is very important. So it's determined as a debt and profitability ratio used to determine how easily a company can pay interest on its outstanding debt. So having a more higher interest coverage ratio means that the amount of income that they are receiving can easily pay off the interest of the debt. Lastly, based on the cost of debt percentage, is how much they are actually paying in terms of the interest. So having a higher cost of debt can be resultant from the increase in Fed interest rate, and this will also cause the interest coverage ratio to drop because the interest of the debts are more expensive to pay off. These three parameters are important to take note, especially for REITs, as they will determine if they can do the following. 1. Having enough buffer room if interest rate changes. So rising interest rate would cause unhedged loans to have higher payment, thus leading to lower interest coverage ratio and increasing the risk of the REIT not being able to pay the debt. Second, availability to loan and purchase new assets to give higher use to shareholders. Lastly, if the REIT has a very high gearing ratio and a low interest coverage ratio, it risks shareholders that the REIT might have to issue more shares in order to create more funds to reduce their gearing ratio, which is usually not desired for many of the shareholders. So you can see from this Excel, so for gearing ratio, I've set a few different conditions that would be given in different categories or different colors. For example, in Singapore, actually the minimum gearing ratio that is required for REIT is 50%. So I've set that as long as the REIT has a gearing ratio below 30%, then it is in green category. Whereas for 30 to 40% to be in the yellow category, as you can see from the chart, and above 40% of gearing ratio to be in the red category, which is the very risky area. Whereas for the interest coverage ratio in Singapore is required to keep above 2.5 times. So I've said that in green, 5 times is required, more than 5 times is required to be in the green section, whereas in the yellow section, 4.4 to 5 times is required, whereas in the red section is below 4. If you can see from this table, there are a few red boxes here and there. If you see the CAGR, the red boxes are in Keppel REIT, iREIT and AA REIT. Whereas for the interest coverage ratio, the Keppel REIT is also in the red category, whereas Keppel Infrastructure Trust, which is a new role they have added, is also in the red category. However, in order to give it to a more context, Keppel Infrastructure Trust is a business trust, so they are actually technically not included in the required zone for what is being set for the REITs. Next, let's talk about the most important parameter that every investor are investing in REITs for, which is the dividend yield. So as you can see from this chart here, the dividend yield are being categorized as similarly to the gearing ratio and interest rate coverage ratio. So a few conditions are being required to be set. So personally for me, I said that to be in the green category, the dividend yield of the current share price must be at least more than 5.5%, whereas for the yellow boxes are in the category of 4% to 5.5%. Lastly, in the red category, if the dividend yield is less than 4%. So due to the macroeconomics, the whole media is talking about the rising interest rate due to bad CPI data. Therefore, it's important to account for the potential effects of interest rate on the respective REITs. With the effects of 0.5% increment of interest rate provided by some REITs, I can roughly estimate that the new yield based on how many times the Fed will increase the interest rate by 0.5% for the rest of the year. This will result in a decreasing yield on the current share price, as you can see from the columns. So let's take Mapletree Industrial Trust on the first row as the example. So based on the current price of $2.56, their current dividend yield is at 5.45%. However, if the Fed increase the interest rate by 0.5 times for 3 more times, which is quite reasonable, the potentially affected yield, assuming that there is no longer any more increase in dividend yield, will result in the new dividend yield to be at only 5.38%. However, these values are required to be taken with a pinch of salt because this increase or effects of interest rate are given by the REITs themselves. However, if the REITs are able to hedge more of their loans quickly or smartly, they would be able to be more resistant to the increase in the interest rate. Therefore, with the new potentially affected yield, more conservative approach can be taken to buy at the right target price. Buying this REITs during this period, in my opinion, can be taken slow due to various reasons. Higher interest rate naturally decreases equity or REITs prices, as things like bonds or fixed deposits, which are very safe assets, will give a more attractive yield. This would result in the assets or money being distributed to other areas of these places, thus reducing the share price and the equity prices. Patients in the market can also get REITs at a higher dividend yield or dollar cost average in if you do not mind the current yield. Lastly, the comment section is used to include any interesting things that I would like to include, such as the distributable DRP program by MIT and what I feel on about some REITs like AA REIT having a very high top 10 tenants percentage of their gross income, which is quite risky in my opinion. So I've also have different charts on the REITs comparison that you can see throughout the years from the returns or the dividend that they are giving out. So some REITs are having a very volatile returns throughout the years, whereas for some REITs they are constantly improve or increase their dividends given out to shareholders. So thank you so much for watching. Apologize that because the market has always be constantly changing, so my video might look that the share price, if you see the recordings closely, there's a change in the share price constantly because I have a code that will constantly be able to update the share price, and as well as the dividend yield will be updated as well. So please like, subscribe and comment on anything that you would like me to talk about more next, and I'll post a link below to my Excel sheet as well. Thank you so much. See you on the next video.